In a situation like this, gold should be skyrocketing right now. But instead, it's got the worst crash since 1983. Well, it did go up like crazy over the past few months, but now it's crashed. The more tensions and uncertainty hit the headlines, the more gold price will go down. It's so weird, right? On the other hand, oil prices are starting to climb. They've doubled from around $60 a barrel to $120. As uncertainty in the Middle East rises, risk assets like gold should be rising too, right? Instead, it's only oil that's going up. What we're actually seeing is something much more interesting and probably more dangerous. First of all, we're seeing two different parts of the market reacting to completely different forces. Oil is reacting to supply fears, while gold is reacting to financial conditions. When oil spikes, it doesn't just mean higher gas prices, it ripples through the entire economy, driving inflation, triggering liquidity crisis, and putting pressure on import-dependent countries as shipping costs rise significantly. And eventually, liquidity starts to tighten. As people have less and less money, things get more interesting. To understand what's happening right now, you have to start with oil. This is how the oil market actually works. A large share of global supply flows through a few critical choke points, such as the Strait of Hormuz. If anything happens there, even temporarily, the impact is huge. We're talking about a system where roughly a fifth of the world's oil supply passes through a narrow corridor. When tensions rise in that region, markets don't wait for missiles to hit tankers. They move immediately. And here's the thing. Oil supply is incredibly inelastic in the short term. You can't just flip a switch and produce more. New drilling takes months, sometimes years. The oil infrastructure is fixed and vulnerable, and production decisions are often political rather than purely economic. So when there's even a small perceived shortage, prices don't just move a little. And don't forget, oil doesn't arrive overnight. It could take weeks or even months. Then there's another thing most people forget. Oil is not just another commodity. It's the foundation of everything in our modern society. You need oil for transportation, shipping goods, and manufacturing many things. Some remote regions need oil to generate electricity. And also, military operations need a massive amount of oil. When markets sense just a little risk around oil supply, they treat it differently and price it aggressively. That's why you're seeing oil rise like crazy right now. It's not because demand suddenly exploded, but because uncertainty did. You cannot afford to run out of oil. When that risk enters the system even slightly, prices move first, and then they move really fast. Now let's talk about gold. Gold is supposed to go up in times like this. When geopolitical tensions are rising, oil prices are climbing, and uncertainty keeps building, gold should go up. And yet, it is not. To understand why, you have to let go of one common misconception. Gold is not a fear asset. It's a liquidity asset, and that distinction is everything. Gold doesn't react to headlines. It reacts to the financial system underneath those headlines. It reacts to things like interest rates, the strength of the dollar, liquidity conditions, and much more. Right now, all three are working against it. Let's start with interest rates. Gold pays nothing, no yield, no dividend, no cash flow. So when interest rates are high, investors have alternatives. They can move into government bonds and earn a relatively safe return, making gold less attractive. It's not because gold is risky, but because it has an opportunity cost. And then there's the dollar. Gold is priced globally in US dollars, so when the dollar strengthens, gold becomes more expensive for everyone else. Demand weakens, and prices come under pressure. But the most important factor most people miss is liquidity. In the early stages of stress, markets don't behave rationally. They behave urgently. Investors don't ask, "Where should I hide?" They ask, "Where can I get cash?" This leads to a very counterintuitive outcome. They start selling assets, and not just risky ones, but liquid ones. Ironically, gold is one of the most liquid assets in the world, so it gets sold too. This has happened before. In 2008, During the early phase of the financial crisis, gold dropped before it rallied. In 2020, during the initial COVID panic, gold sold off sharply before exploding higher. It's the same pattern in a different crisis. So what you're seeing right now is not gold failing. It's gold behaving exactly the way it historically does in the early stages of stress. Here's the thing. You've probably heard that big money is rotating from gold into oil. Well, some big players are indeed selling gold and moving into oil, but that's not the whole story. In reality, there are multiple players, different time horizons, and completely different reasons for trading, all happening at the same time. Yes, some hedge funds are rotating into energy. They see rising geopolitical risk, significant upside in oil, and fast-moving supply shocks. They needed money to buy more oil, and as a result, they took profits in gold, especially after a strong run, and moved into oil. And yes, this is happening right now. And what you're seeing is not one clean trade. It's three overlapping flows: tactical rotation into oil, forced selling out of gold, and macro positioning against gold. All three are hitting the market at the same time. So, when people say money is moving from gold to oil, they're simplifying a much more complex reality. Some of it is rotation, but a lot of it isn't. The cleanest way to think about it is this: oil is being bought aggressively because of opportunity, while gold is being sold for multiple reasons, not just one. That's why gold looks weaker than it should, because it's fighting several forces at once. When an asset is under pressure from multiple directions, price action starts to look confusing. But once you break it down, it's not confusing anymore, right? When oil prices go up, someone has to pay for it. For oil-exporting countries, higher prices are great. They make more money, secure stronger balance sheets, and enjoy more dollars flowing in. But it's the exact opposite for oil-importing countries. They face higher costs, bigger trade deficits, and, of course, a much greater need for dollars. Global energy markets are priced in US dollars, so when oil rises, countries that depend on imports suddenly need more dollars to buy the same amount of oil. If they don't already have those dollars, they have to get them. That's where the pressure starts building. There are only a few ways to get dollars in a short period of time: tap into their foreign exchange reserves, borrow from other countries, or sell off assets. Often, those assets include gold. This is the part that rarely gets talked about. Gold is not just an investment. It's a reserve asset held by central banks as a form of financial insurance. In times of stress, they'll use that insurance. As oil prices rise, you end up in a situation where countries are forced to liquidate assets to fund oil imports, creating indirect pressure on gold. It's not because gold is weak, but because liquidity is tight and they need the cash. Let's piece everything together. What you're seeing right now, oil rising, gold falling, liquidity tightening, isn't random. It actually follows a playbook that we've seen multiple times before. Once you recognize it, you can start to understand where we are, and more importantly, what comes next. Think of this as a four-phase playbook. Phase 1. This is where everything begins. Uncertainty enters the system, whether through geopolitical tension, energy shocks, or financial instability. Markets don't panic yet, but they adjust. Investors start reducing risk, funds begin deleveraging, and cash becomes king. This is where gold often drops. Investors aren't thinking about protection yet, they're thinking about liquidity. Phase 2. The pressure expands as higher oil prices hit economies. Import-dependent countries feel the strain, currencies weaken, and financial conditions tighten further. Volatility increases, markets become unstable, correlations break, and assets stop moving the way they should. If this sounds familiar, it's because this is exactly what we're starting to see now. Phase 3. Eventually, the pressure becomes too much, and central banks step in. They cut rates, inject liquidity, stabilize markets, and essentially turn the money printer back on. When that happens, the entire dynamic shifts because liquidity goes from scarce to abundant. Phase 4. This is where gold finally does what everyone expects it to do. It rises exponentially. Gold doesn't just respond to fear, it responds to currency debasement, excess liquidity, massive money printing, and a system where money is being created faster than confidence can keep up. That's when gold becomes the trade. So, where are we now? Based on everything we've discussed, we're somewhere between Phase 1 and Phase 2. Liquidity is tightening and stress is building, but policy hasn't fully responded yet. This means that gold falling right now is not a contradiction. It's a confirmation of the phase we're in. If stress spreads, central banks will be forced to respond, flooding the system with liquidity, and gold will finally move. When that happens, it won't be subtle or gradual. It will be fast. So the next time you see gold falling while oil rises, don't think of it as a market anomaly or dismiss it as noise. Think of it as an early signal that something is shifting. When gold finally confirms the move and starts rising alongside everything else, the situation will have already changed. By then, the opportunity is no longer in understanding the signal, it's in reacting to it. And that's exactly what the market is quietly telling you right now, if you know how to read it.